We just saw the 30-year anniversary of the 1987 stock market crash. Do you see any parallels between then and now?
Sadly, I do. The crash of '87 was a very formative period for me because I really just started in the business, and how's that for a wake-up call? And so the lessons of that era are very strong with me. In one sense, the stock market is eerily similar in the fact that it never seemed like the market was ever going to go down again. It would go up every day, and I think a lot of people almost have that feeling now. One big difference was that the bond market really had started to sell off every day, and the bonds were sort of approaching a bear market as the stock market continued to ramp higher. That trade unwound itself very quickly. They say one of the catalysts was a huge asset allocator, a big pension fund who said, bonds are cheap, stocks aren't. I'm going to move my assets from one to the next. Whether or not that was the actual trigger, who knows? Another takeaway from that is that was the first test of what they used to call portfolio insurance. There was this belief that what they'd sold around the street was, don't worry about your stock holdings because you can always hedge them with stock futures. They're very liquid. You don't need an uptick to sell short, and there's plenty of liquidity there, and don't worry about it, which was true to a point, and it's especially true when there's a rising market and you don't need to hedge. But then if everybody's rushing for the parachutes at the same time, that's not really a good thing. And I think so. What you had there was really the first test of portfolio insurance and using the futures markets, and to a limited extent, index options as a hedge. And that test didn't go well. Every financial product has its test. It's just a question of when and where. And I think the product that is most at risk of a test right now are the VIX complex. I think you've got a level of popularity in the general public that you've never seen before. I think you're seeing very high speculative short interest in VIX index futures as measured by the commitment of traders. You're seeing very high short interest in VXX. You're seeing actually record long open interest in VXX. It's not open interest. It's actually shares outstanding, but that's the option trader in me coming out and using open interest. And so you've got trades and speculation and volatility that you've never seen before. All of this is happening while volatility is stretched to really historic lows. That's the thing that scares me the most, is at what point does volatility as an asset class get its test? And that's what I fear will be the takeaway from whenever this market has a turn. And I think that is what could, and I really emphasize could, because I see this as a possibility, not a probability necessarily. But if there is a turnaround, I think it can be really exacerbated by the fact that you've got people betting on a short volatility regime or low volatility regime that really have never placed bets of this nature before, and that's the kind of financial situation that can have nasty repercussions. So, going back to your original question, I do see echoes of 1987. They say history doesn't repeat itself, but it often rhymes, and I think that's kind of the feeling that I'm taking away at present.